All right, so we've got this question here. Okay. The following information relates to a company that sells one product. Okay. So in January and February, with the number of units that are sold and also the number of units that are produced. We've also been given this information: selling price per unit 16 kwacha, cost per unit material 5 kwacha, direct labor 3 kwacha, variable production cost 2 kwacha. They've told us fixed production costs are 75,000 per month. There is no opening stock, and the company policy is to absorb fixed overheads on the basis of direct labor cost required. Okay, prepare profit and loss statements for the months of January and February on the basis of marginal costing and absorption costing. Okay, so for marginal costing, we'll start with marginal costing, where we value the inventory at the production overheads. Okay, fixed costs are treated as period costs and they're written off in the period that they are incurred. Okay, so either we can first calculate our closing inventories here, or we can first calculate the total variable production cost. So let's start with step one, calculating the total variable production cost. Okay, so we have direct materials, which I put as DM, direct materials, 5 kwacha, direct labor as DL, 3 kwacha, variable production cost, V, variable production cost also put VPC, 2 kwacha. So get our total variable cost. Okay, 5 plus 3 plus 2 is 10 kwacha per unit. Okay, so this is what we're going to value our inventory with. Even the number of units that we produce, this 10 kwacha, we're going to value them at this. Okay, so this is our total variable production cost for each unit, 10 kwacha per unit. All right. Step two, we need to find out what is our closing inventory, because we've been just given information about how many units we're selling and producing. Okay, we've been told there's no opening inventory for January, but there will be some closing inventory. And then also February might have some also closing inventory and opening inventory too. Okay, so we're going to say we'll put here January 2023, and here we'll put Feb 2023. Okay, so now the way we get our closing inventory CL equals opening inventory plus units produced minus units sold. Okay, that is how we get our closing inventory. Okay, so here January we don't have any opening inventory. Okay, we produced how many units? Produced 25,000. Right, and then we sold 18,000. So our closing inventory, okay, we're going to say opening inventory is 0, so 0 plus 25,000 minus 18,000. So the closing inventory for January is 7,000 units. Okay, and this is going to be the opening inventory for February, 7,000 units. All right, then in February, we produced 25,000 and we sold 32,000. So I want to get our closing inventory. So it's opening inventory plus production minus units sold, zero. No, difficult zero, let's see. Oh, 27 plus 25, that's 32,000. Okay, so there's no closing inventory in February. Yes, no closing inventory in February. Okay, so we can now get our profit statement. Okay, our profit statement. We'll start for January. January profit statement. Right. So we're going to start sales revenue. We're going to find out how much sales revenue we made. So in order to get the sales revenue, it's the number of units sold times the selling price. So our selling price is 16 kwacha. Okay, selling price 16 kwacha. We sold how many units in January? 18,000. So our sales revenue is going to be 16 kwacha per unit multiplied by, we sold 18,000 units in January. So our sales revenue is 288,000. Right? Yes. Then now get our cost of sales. Okay, cost of sales, we start with our opening inventory. So here we do not have any opening inventory. Would have valued it at least 10 kwacha here. So opening inventory, zero. Then we go to the production costs. Okay, so production costs, we produced 25,000 units and it costs 10 kwacha to produce one unit. So we're going to say the production cost 10 kwacha per unit multiplied by, we produced 25,000 units. So 250,000 is our production cost. All right. Yes. Okay, then you always add your opening inventory with your production costs to give you the total cost of goods available for sale. Available for sale. Okay. And you're just going to say 250,000 plus zero, we get 250,000. Okay. Then to get our cost of goods sold, we need to deduct the closing inventory. So you're going to say less closing inventory. Again, opening inventory, production costs, and closing inventory are valued at this total variable production cost of 10 kwacha. So our closing inventory is 7,000 units. We multiply it by this 10. So we're going to say 7,000 units multiplied by 10, we get 70,000. All right. So we get our closing inventory. Now we say cost of goods sold, COS. It's the total cost of goods available for sale minus the closing inventory, 180,000. Okay. And this total cost of goods sold is also, think of it as your total variable cost. Okay. Think of this also as your total variable cost. Let me actually put here. brackets total variable cost. Yes. So once we've got our total variable cost, we can now get our contribution. Remember, contribution is sales revenue minus your total variable cost. So 288,000 minus 180,000. Our contribution is 108,000 kwacha. Okay, 108,000 kwacha. Then we can get our net profit. You're going to say less fixed costs. So here we've only got one fixed cost, 75,000 per month. Let's say less for 75,000. You're going to say 108,000 minus 75,000. You get 33,000 as your net profit. Okay, 33,000 as the net profit. So that is for January. Okay, now we can go to February. Okay, so February, our sales revenue, we sold how many units? 32,000. Each unit is going for 16 kwacha. So the sales revenue, 32,000, number of units sold, multiplied by the selling price. You get 512,000 kwacha. Okay, yes. Opening inventory, we've told it's 7,000. We value the opening inventory at this total production cost of 10 kwacha per unit. Okay, so opening inventory, you're going to say these 7,000 units valued at 10 kwacha per unit, 70,000. Production costs, we produced 25,000 in February, and we're valuing it at 10 kwacha, so it's going to be the same 25,000 times 10 kwacha per unit. Oops, what did I do here? Yeah, we'll put 250,000. So it's the same amount here, 250,000. So we get the total cost of goods available for sale, 7,000 plus 250,000, or 70,000 plus 250,000, 320,000. This is the total cost of goods available for sale. All right. Then closing inventory, we were told there is no closing inventory, so it is zero. Okay. So our total variable cost of goods, total variable cost going to be 320,000 minus zero, we get 320,000. Okay. Then now we can get our contribution. Contribution, you just say sales revenue minus the total variable cost, 192,000. And now we can deduct our fixed costs to get our net profit, 192,000 minus 75,000, 117,000. Okay. Yes. So what we can see from this example here is when the business produced more, even its contribution increased. All right. Also, its variable costs, total variable cost also increased. But eventually, all in all, their contribution increased, and they were able to make more, remain with more of a net profit than in February. Right. So this is how you make these marginal costing statements. Okay. First, you get the total variable cost of producing each unit. That's what you're going to use to value the opening inventory, production costs, and closing inventory. Right? This one operates similar to a trading account. All right, it's very similar to a trading account. Just that instead of purchases here, we had production costs. All right, and here, as I said, cost of sales in this case is the total variable cost. All right. Yes.